You will notice my voice change a little bit because I am coming down with a cold, so I do apologize for that. But I wanted to talk about the debt ceiling adjustments. But before I get into that, um, there's this one point in Apple's history where they had more cash on their balance sheet than U.S. government. They had 160 billion in cash versus U.S. government only 49 billion in reserves. That just goes to show you that how much large corporations can have influence on our government through lobbying. Companies like J.P. Morgan Chase and Wells Fargo have been lobbying and getting their ways for decades. I'm sure you already know all that, but if you want to read the this article, you can either turn this slide into a slideshow and click on the link, or if you're not in that mode, then you can just copy and paste that link into your web address. Alright, so what happens if, let's say, we can't pay our debt down? What do we do in that case? So in that case, our government decided to raise the debt ceiling on our quote-unquote congressional credit card. The reset to $17.2 trillion, and I don't know why I wrote the entire figure down. I guess it's just my obsession. That reset marked the fifth effective increase in the debt ceiling since August 1st, 2011, when our debt was only 14.3 trillion. So of course, Republicans had a fit, but they did decide to raise our so-called credit line one more time. It's kind of like, imagine you have a credit card and you cannot pay the balance down, and you have a minimum payment due, and then you have another credit card offer. So what you do is you just raise the credit line so you can cash advance and then pay your minimum payment. It's kind of like the same concept, which is terrible if you ask me. Something, we need to think about paying down the debt instead of just kicking the can down the road. Anyway, so if we default on our debt, then our Moody's credit rating will fall most likely. Hence, it will push up the interest rates on our interest expense. So, a lower credit rating will equate to a higher interest rate, and it will equate to a higher interest expense. And the last bullet point, I always advise everyone that I know to, if possible, always try to accumulate gold coins, physical gold coins, just in case there is a crisis or another catastrophe that happens, and you see all global countries flock to gold, and God forbid if you have to leave the country, go to another place, then you will have your gold coins, and most likely they'll be much higher in value, because gold is always looked at as a safe haven when there is a major financial crisis. All right, so let's talk about the dark side of capitalism. And I don't want to sound like a socialist, saying dark side and have these black color with the yellow, but I want to point out to people that look at these companies as entities that will always be socially responsible and always do the right thing. Well, not necessarily. So each year you got 443,000 people that die from tobacco, and this is not going to stop them from making a profit. Business must go on, and this shows the hypocrisy of why tobacco would be legal and marijuana is still looked at a drug in a lot of states in the United States. So a company like Philip Morris, who makes Marlboro, Parliaments, they have as I'm writing this, they have a market cap of $135 billion. And they have a dividend yield, they pay a dividend yield of 4.7%. Okay? Another company, Reynolds American, they make the American spirits. They have a market cap of 31 billion, and recently they got the biggest lawsuit awarded, I think from Florida, and the $23 billion lawsuit was the biggest lawsuit in tobacco industry. And this company also pays a dividend yield of 4.6%. But the point I'm getting at is these cigarette companies that kills people, they pay a nice 4.6, 4.7% a year dividend to entice investors to stay with them. Whereas a biotechnology sector that saves millions of lives, and I mentioned companies like Celgene that makes cancer drugs, market cap of 70 billion, doesn't pay a single dividend. Another, Gilead Sciences, they make drugs for HIV and hepatitis C. Again, large company, but it doesn't pay a dividend. It is considered a growth stock. We will touch later on between the differences between growth stocks and dividend stocks. But a dividend stock is for people who want their constant cash flow coming in no matter what happens to the stock price. As a matter of fact, when the stock price goes down, dividend yield actually goes up. So people in their 50s, 60s, they're more prone to invest and stay with a tobacco company or any company that pays a higher dividend rather than take a risk with a growth stock.
The black market purchases and its impact. I know I touched a little bit on this topic earlier on, but again, no financial analyst will talk about this or mention that Harley Davidson might fare well during recession because of drug sales, money pouring into the company's bottom line. But I will. I have no problem saying that. I don't have a boss. No one's gonna fire me from my job, so I can speak my mind. As a matter of fact, that was one of my core investments after the recession, as Harley Davidson recovered rapidly from 2009 to 2012, I think. I'm not saying illicit drugs was the primary reason, but I'm just saying you shouldn't believe everything these cookie cutter financial analysts tell you on CNBC. Okay, they're just doing their job within parameters set by their bosses. So look at different ways that the money flows. If let's say an illegal immigrant buys a burrito from Taco Bell, boom, that money, who knows where that money came from? No one does no one looks at the trail. But every morning these people need to eat somewhere. So pick a public company in the food and restaurant industry. Of course they're going to benefit. So there's a lot of money that comes from outside of the United States into our businesses and their bottom lines, and then trickle down as salaries and so forth. For example, foreign national purchases of cars and other goods with Bitcoin and other digital currency. I don't know what month and what year was it, but somebody bought Tesla with Bitcoin. And a lot of people don't know that there's this different world of all these other digital currencies which actually hide the source of the money that it comes from, those purchases. So I know Bitcoin and Litecoin, I believe you can actually know where the money is going, but there's a lot of smaller digital currencies that draw in investors because of their ability to hide the source of funds and the transactions that occur. So yeah, the black market does benefit from a recession as more people use drugs, commit crimes, etc. Estimated to be a $1 to $2 trillion industry in US alone, which finds its way into American companies' bottom line figures. And lastly, you need people to commit crimes, as prisons are also a multi-billion-dollar businesses. I bet you didn't know that. Well, now you know. If you go to Google Finance or Yahoo Finance and you type these symbols CXW and GEO, you will see some of these companies that are actually privatized prisons. So, again, think outside the box. Don't just read articles and believe what you read. Do your own research. there's so much that you can find in the markets, and there's so many different companies with phenomenal business models. It's just a very interesting world. And by trading stocks, you also get to know, because you read so much, you get to know what's out there, what products are out there, what products are due to come to the shelf, and which products will be outdated very soon. For example, there's this company, iRobot. I don't know if you've heard of it. iRobot made designed those vacuum cleaners. The Roomba, I think it's called. Roomba vacuum cleaners. And those are the round vacuum cleaners that actually just vacuum by themselves by hitting the wall and then going to a different direction. So now iRobot has plans. They also made a lot of robots for the military, but now they're thinking in the future they're actually making robots that is going to replace farmers. It's going to plant trees, harvest, and pretty much do everything a farmer is going to do. So it's very interesting how technology is changing the landscape, and also puts a lot of people out of work, as we see in the Home Depot and all the grocery stores that have the self-checkout lines, which I never use. And when they push me to go use that self-checkout line, I tell them, well, do you want to continue having a job or not? And it's amazing how many people don't understand what I'm trying to tell them. Like, hey, you're replacing yourself pretty much. If I come and use this line, then in maybe a couple of years you won't even be here anymore. All right, let's move on. Now, you might be wondering, why was I telling you all this? It's really important, guys, to do your own due diligence. Don't believe everyone that has an opinion and opens their mouth on television. Half of the analysts are wrong half the time. Okay? I want you to become a shrewd investor or a trader who reacts to realistic facts. Don't just follow in fear and panic of the media pundits or the financial analysts. Their job is to create volatility and instill panic in you, so their funds will buy in cheaper after a massive sell-off. It's a dirty game. It's a dirty, dirty game. I don't know why I put it twice. But you really, really, really need to take this very seriously, because so many people in the United States, and I've driven through every state, in the middle of the United States, they get so easily brainwashed by television. And it's amazing to me. I've seen it in front of my own eyes. Television controls these people's minds. I'm just hoping that you're just not one of these people, okay? So again, also another thing, when you watch the news here, it is so filtered that it's not news anymore. When I watch the news of Russia, when I watch the news of Armenia, and any of the countries on the other side of the Atlantic Ocean, the news is not filtered. Okay, so I know so much stuff that American people don't even get to hear and see, and it's just crazy to me. Anyway, this mindset of being a realist and doing my own research, making sure that it jives with my logic, everything that I read and I hear and I see. This type of mindset made me a small fortune in Bank of America stock, Facebook, and Tesla, because there were times where the majority was selling in fear, and I was just sitting on the sidelines and just laughing and just waiting to buy it back cheaper. And these are great companies, and I knew exactly how the media exaggerates everything to a point where they try to sell the stock to the ground as much as possible, push it as low as it can go, and then they buy it back. and it's just amazing. I saw this with Bank of America going to $4 because Bear Stearns went out of business, so they're like, oh, Bank of America might follow suit, but hey, this is Bank of America. 1 out of 4 people in the United States has an account with Bank of America. They just bought Countrywide. They bought Merrill Lynch. They are too big to fail. On the other hand, Facebook, just looking at the Facebook's business model and their growth opportunities, and people's addiction to Facebook. And when IPO came out and the stock went to like what 25, I think. I bought it all the way back to 60, all the way. I kept buying every chance I could. I traded it with option calls and puts as the stock was actually appreciating. And last but not least, Tesla. Tesla was a phenomenal stock for me. I actually got in it when it was about 50, 55, 56, and I rode it to 100, 150, and then I traded it more towards 200. Again, I want to stress it one more time, and then we can move on to other juicier things. Do your own due diligence, do your own homework, read your own financial statements, your own 10K reports, and watch the news, see what stocks are being traded, and at the end of the day, make your own decision. I had this one friend who came up to me and said that his uncle lost $1 million, almost $1 million, in the stock market during the 9/11. Excuse me. And I've also heard other people tell me their horror stories of they knew somebody who lost a lot of money on the stock market and he never touched it again, blah, 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 blah. And all I can think of it in my head is, well, your uncle or whoever it was made some type of a mistake. Either he put all his money into one stock, or maybe he put all his money in the stock market and never looked at it again. So he was like an investor, he was not a trader. He invested everything and just, forgot about, looking at him, or was not an active investor. And there's always some type of a reason why this happened. Or sometimes a person will not have enough knowledge and they'll touch the market and make the wrong mistakes. So that's why I wanted to put a couple of horror stories together to show you that, of course, there has been suicides from the stock market. There has been some tragic events that occurred when people lost all their money. One of those people was Jesse Livermore. He was one of the best traders out there, and he committed suicide. He made $3 million from panic of 1907 when he short sold the market. Then he lost it all on a cotton trade by violating many of his own rules, violating his own discipline. He made it back on the stock market crash of 1929 by short selling again and making $100 million. Now think about that, where America was dealing with depression and 1 out of 4 people couldn't find the job. You got 25% unemployment, but then you had people like Jesse Livermore who became multimillionaires. Again, short selling is when you profit when a stock drops in price. And then Jesse goes on and he marries Harriet Metz Noble in 1933, and this was Harriet's 5th marriage. All of her ex-husbands committed suicide, and Jesse Livermore was no different. Some speculate that his clinical depression and his marriage was the true cause of death, as he shot himself in a hotel in November 28, 1940. Now, a more recent suicide was let me try not to butcher this guy's name, René Thierry Magon de la Villeuche. I don't know. I need to brush up on my French. It's funny. I went to Montreal and I couldn't speak French, and I got so many parking tickets because I couldn't even read the parking restriction signs on the street, and I got lost, and it was just terrible. I was not expecting everything to be French, but I paid the price. Anyway, Rene, whatever his name was, he killed himself after losing 1.4 billion dollars, all of his net worth, to Madoff, Bernie Madoff. And when you look at this, it's tragic, but this guy got greedy. Madoff was giving him the best return possible, and he was like, you know what, this guy is always going to give me this type of returns, and he put all of his money, all of his net worth, and gave it to Madoff. Now, who are you going to blame here? Of course, yeah, Madoff screwed off a lot of people, but no matter how much money you're making from one investment, you shouldn't just take all your life savings and put it on that investment. That's stupidity to me. You should always, 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 always diversify, and we'll get to that later on. As I'll stress the importance again to diversify between gold, real estate, and other types of investments, and then you put some on the stock market. So you spread your money out. You don't give $1.4 billion to one guy. That's just greed talking. So, bottom line is, do not let your winning euphoria force you to. It is very crucial to stick to your discipline. If you keep a vigilant eye on the risks you take, you will never allow your emotions to take over. Do not forget this rule. It might not make sense to you right now if you haven't traded in the past, but once you read this after having made, let's say, a couple of thousand trades, you will know what I'm talking about. If you watch your risk all the time and you always calculate the worst case scenarios of how much your stock could drop, you control your position size, you will never allow your emotions to take over. Okay, you will act with discipline, and you will know exactly what to do at what circumstance and what situation. So some speculated that Jesse Livermore's main weakness was taking too much risk and going against his own principles of listening to others. How many times have you had somebody tell you a stock tip? Hey man, the stock is going higher. It's gonna shoot. It's gonna shoot to the moon. You should jump on it. But by the time the news is out and you listen to your friend and you go buy a certain stock, it actually tumbles the next day. But I'll tell you this again, there has been scenarios like in my very first trade where I told my manager that I made this much money and he bought in later on and the stock continued to rally. So of course, there's always exception to the rule. In this scenario, Hurricane Katrina was making oil prices surge higher and higher every day. So yeah, you had this several day period where if you got in at that time, you would continue seeing profits. And lastly, let me just show let me read a couple of quotes by Jesse Livermore. I respect him as a trader, and he said some very wise things that I've learned. All through time, people have basically acted and reacted the same way in the market as a result of greed, fear, ignorance, and hope. That is why the numerical formations and patterns recur on a consistent basis. And then the game of speculation is the most uniformly fascinating game in the world. But it is not a game for the stupid, the mentally lazy, the person of inferior emotional balance, or the get-rich-quick adventurer. They will die poor. Okay. I am excited to actually start talking about the indices, and maybe I should say we officially begin now. No, we have begun for a while now, but now we're because all this time you were probably saying, Edgar, what does all this have to do with trading and investing? Well, now I'm actually going to get to the nitty gritty. All right. Okay, guys, so when you buy your first stock, it is going to belong in any of the three major indexes: Dow Jones, NASDAQ, S&P 500, Standard and Poor 500. This is probably the last time you will hear somebody say Standard and Poor 500. Just know that when they say S&P 500, that's what they mean. Um, your stock, I mean, no matter what happens to your stock, you always keep an eye on these three indices. Okay, your stock might skyrocket at market open, um, let's say because of great earnings results, but by midday, the indices might reverse and start falling, bringing down your stock with them. So it doesn't matter if the stock you bought happens to be in Dow Jones. If let's say S&P 500 starts to fall, then most likely all the other indexes will follow suit. Not always, but most of the time. Sometimes NASDAQ will go the other way, but when you're looking at a longer term basis, all three indexes are actually they trend in a parallel fashion, and they're very correlated to one another. So let's go ahead and look at the Google Finance for a second. And going forward, I want you to put google.com finance /finance and yahoo.com /finance and finviz.com in your favorites, as we will refer to them, to those sites throughout the course. So let's go ahead and look at this for a second. Okay, so we're going to go to google.com finance, and as you can see we have Dow Jones, the blue line, S&P 500, the red line, and NASDAQ is the orange line. They have trended fairly in a parallel fashion on a daily chart. But when you click on it, you're looking at a longer term chart. When you look at 3 months or 6 months, you can see they pretty much follow each other. So again, always keep your eye on these three indices. Now, Dow Jones Industrial Average is a price-weighted index of the 30 largest publicly traded companies on the New York Stock Exchange. Guys, these 30 companies employ about 1% or 2% of the US population. These are the giant companies that are too big to fail. Not always, but I would say 99% of the time, they are too big to fail. The reason I say that is because sometimes there's companies that get kicked out of Dow Jones and they come back to Dow Jones after they meet the listing requirements. Bank of America was one of those companies where they suspended the dividends, and they were consequentially kicked out of Dow Jones. But these 30 stocks in the DJIA dictate the movement of the entire stock market and are the oldest continuing US market index. So some of the companies, I'm sure most of the companies like American Express, Boeing, Caterpillar, Cisco, Chevron, Disney, Goldman Sachs, Home Depot. How can you go wrong investing in Home Depot for the rest of your life? One of the best way to invest long term is every time there's a major sell-off in any of these companies, you should just start buying. Don't even think twice. Just start buying these companies. I remember that one time Walmart had this. There was a news about Walmart hiring illegal immigrants. Again, the stock sold off a couple of percentage points because of that news, and that's exactly when you should have got in. And then there's cases where you might have to think about the longevity of a company when there is a major type of risk like a consumer preference. For example, when we're talking about people being more health conscious. Well, that is definitely going to affect McDonald's, which is one of the companies here, MCD, and Coca-Cola. So, um, when I say buy for the rest of your life, and every time there is a bad news, jump on the stock, um, besides jumping on the stock, think of the longevity of this company. Because there is a small risk that eventually maybe this company's cash flow can be severely impacted because of consumer preference change or what have you. So even though they belong in Dow Jones Industrial Average, that doesn't mean that they're fully bulletproof. That's all I'm saying. Other companies in it like Nike, Pfizer, AT&T, Verizon, Visa, Exxon, these are great companies to invest in. And if you ever want to look at all the 30 companies, you can just Google Dow Jones Industrial Average 30 stocks or 30 components, and you will have the 30 stocks in front of you. One important aspect that I want to point out is Dow Jones is a price-weighted index. So the index places more weight on stocks that have a higher closing price. For example, Visa and Goldman Sachs, they're actually one of the highest priced stocks in Dow Jones as of the moment. Let's go ahead and take a look at their closing price right now. So Goldman Sachs is at 195.45. Visa is 266. So let's just go ahead and really quickly take a look at the 30 stocks. Excuse me. Yeah, so just taking a quick look at the 30 stocks. The most expensive ones are Goldman Sachs 196 and Visa 268. So again, the higher priced stocks, they get the highest weight on that index. Now, NASDAQ is often referred to both a trading exchange as well as an index, but it is a global electronic marketplace for buying and selling securities, as well as the benchmark index for more than 3,000 US tech stocks. Some names you already know: Apple, Google, Microsoft, Cisco. So one of the best ways to know if your stock belongs in NASDAQ is to count the number of letters in the stock. Most stock symbols do have only 4 letters. So the exchange does trade some banking companies, retail names, and even auto names such as Tesla, TSLA. The benchmark is fairly crowded with tech companies, or as I like to call them, the Fantastic Four. Apple, Microsoft, Google, Cisco. NASDAQ was created by the National Association of Securities Dealers, and AQ stands for automated quotations, to enable investors to trade securities on a computerized platform, and begin operations in February 8, 1971. Another noteworthy index to track, guys, is NASDAQ 100. It's a popular index that tracks 100 of the largest companies in NASDAQ. And one of the best ways to trade that is PowerShares QQQ Trust. It is a fairly great index and it's very liquid. Liquid meaning that it has a high volume and it's fairly safe. Last but not least, we have my favorite index, which is S&P 500. A great way to trade the entire S&P 500 is to buy the exchange traded fund SPY, or sometimes it's referred to as SPY. So SPY, when you buy first of all, let me tell you what exchange traded funds are. For now, just think of them as a basket of stocks. There were mutual funds, and after mutual funds, they invented exchange traded funds, which allows you to trade a basket of stocks on a daily basis. So if you want to trade the entire S&P 500, you can just buy SPY, which is one of the highest and the most liquid ETFs out there. So yeah, let's talk about what S&P 500 is. It's an index of 500 large cap companies, which uses a market cap weighting structure that places more weight towards companies with larger size. So the S&P 500 is designed to be a leading indication for US equities and is meant to reflect the risk return characteristics of the large cap universe. So even though Dow Jones 30 has larger companies in its index, people view S&P 500 as a better indicator for the overall economy because it has 500 companies instead of 30 companies, despite them being a smaller size companies versus the mega caps in Dow Jones. So S&P 500 has large cap companies and even mid cap companies, whereas Dow Jones has the mega cap companies. As of the time that I'm writing this, the entire market cap of S&P 500 is roughly $18.5 trillion. In some places, you might see S&P 500 referred to with a ticker symbol .INX, and sometimes you might see .GSPC. So let's see what Google Finance says right now. I think on Google Finance it's .GSPC, or it could be .INX. I don't know. Alright, so clicking on S&P 500. Yeah, see right here it says INX. It's interesting. But anyway, I mean, if you see .INX or .GSPC, you know that they're talking about the S&P 500. Alright, let's go back to the course. So it's also noteworthy to mention that there are smaller S&P indices, such as S&P Mid Cap 400. Then you got S&P Small Cap 600, and there's Russell 2000. But the whole point of this course is to keep things simple. So I'm not gonna bombard you with information that you're not gonna need, and I'm not gonna make this course any longer than it needs to be. Alright, moving on. The entire market is broken down to less than a dozen sectors. So sectors are distinct subsets of the market whose components share similar characteristics. Then each of those sectors are broken down into different industries, as you will see on the next slide. So stocks are grouped into different sectors depending upon the company's business. So the largest sectors include basic materials, consumer goods, financial banks, and technology in terms of market cap. Just a reminder, be sure to look at your glossary sheet for the words that are highlighted in red. Market cap, which is short for market capitalization, is referred to the size of the company, which is calculated by outstanding shares multiplied by current price. Again, market cap is referred to the size of the company, which is calculated by outstanding shares multiplied by current price. You don't need to know the calculation, but it's always good to know as much as you can. This information is always available on any broker platform or Google Finance, Yahoo Finance. All right, so just to let you know that different websites and different brokers might have slightly different names for sectors and industries, which really ticks me off, but that is the reality. So we will look at an example on the next slide, but for now, let's go ahead and add another website to your favorites list, which is stocktwits.com. And this is a site that I periodically look at. For example, it has a nice social signals heat map. See, it shows all the sectors that you have in there. But see, within sectors, some stocks have turned red, some stocks have turned green. Um, and once you click on it, you can actually see those companies, whether they close the day up or down. And I also like, it shows me what stocks are actually trending, like up on top. It shows you what's currently trading, and when you see a lot of people talking about it, then usually there's a high volume and there's a lot of social activity on that stock. But do I really care about people's comments and what their needs to be right all the time? No, honestly, I give less than a shit. I completely ignore these amateurs who pick sides and try to prove each other wrong. It's pathetic and a waste of time. So, get what you can from this site. It has a lot of cool tools, and in the last couple of years, this site actually has grown quite a while. Most investors stick to a sector that they're comfortable with. For example, Warren Buffett to this day still doesn't like the technology sector since he can't pin a valuation to it. And I can completely understand where he's coming from. Because tech sector as well as the biotech sector have substantial R&D costs, research and development costs. So until they turn the corner and start profiting, or even in their maturity phase, they have enormous goodwill and patent valuations on technology that they have, drugs, and it's really hard to compare one tech company to another company within the same industry. And likewise, one drug company to another drug company. I personally don't like the food industry because I just don't understand the patterns I see, or I cannot identify trends to take advantage of. For example, like hogs futures will go up, and dairy products will rise in price, but then you'll expect the food stocks to go down, but instead they will rally on the news, or they might get affected in a few days later. So the restaurant sector is just very tricky sector. Not sector, I'm sorry. The restaurant industry is a very tricky industry to trade. So just be cautious. Alright, so now on this slide you can see that each sector, for example, basic materials is the sector. Each sector is broken down to more than a dozen industries, but in this slide I'm only showing 3. But just know that there's more than a dozen industries. In total there's hundreds of industries. And what makes it worse is the actual language, the verbiage of it differentiates from one broker or news site to another. And we will see that in a little bit. But what I want to show you is that sometimes certain industries, and remember this guys, it's very important, sometimes in certain industries, one industry might have a direct inverse relationship to another. So let's say, for example, oil and gas will have most of the time, not all the time, most of the time it will have a inverse relationship to transportation industry. So let's look at a example of FedEx, which belongs in the transportation industry. Let me go to Google Finance for a second. It's faster than Yahoo. So we're going to look at FedEx, and we're going to plot and compare it to the oil ETF, which is XLE. It's a basket of major oil companies. So of course, on a 3-day basis, there's not much you can see here, but if I look at 6 months, for example, look at that. It's almost symmetrical. Blue line is FedEx, and FedEx is rising. It rose almost 20% at the same time that oil was tumbling from August to December of 2014. So it's your job as a trader to look for these things. You always compare to see what's happening to this industry versus that industry, and you will see that some industries have direct correlation, or they have inverse relationship, or a semi-inverse relationship. I'm not saying this is always the case, but most of the time you will see and detect patterns that will help you minimize your losses and increase your profits. So when it comes to a point of hedging, let's say you have a lot of transportation stocks, but you have made you had a nice run. Okay, you made a lot of money, and it's not realized, which means you haven't sold your company, you haven't sold your stocks. Then you might want to consider hedging in oil stocks, just in case your transportation stock sells off because of an oil recovery or a short-term oil spike in prices. So another thing I wanted to show you is the terminology that's used from one site to another. So let's go ahead and go to Yahoo Finance this time. Okay, so we'll go to Yahoo Finance, and let's look at Panera Bread, PNRA. So in Panera Bread, if you on the left side under the company heading, click on profile, and you will see the sector. It says services. Industry, it says specialty eateries. Okay, so this is Yahoo Finance's verbiage. And if we go to Google Finance, type in Panera Bread, you will see that right over here the language is a little bit different. It'll say cyclical consumer goods and services for a sector, and for an industry it'll say cafes. So not a major issue, but I just want to let you know that you are gonna experience different verbiages for the industries and the sectors within websites such as Google and Yahoo, but also your broker sites such as Scottrade, TD Ameritrade, or what have you. So don't panic, it all means the same thing. Now, who are the market participants, and what is the frequency of those market participants? The big players are the hedge funds, and as homework I would like you to research, and by research I mean Google. I swear, Google made millions of people so much smarter after the invention of smartphones. So please Google the biggest hedge funds in the world and get to know the owners and their size. I'm sure it'll be a very interesting read. Just don't fall into a depression after you find out how much they make each year, because that will depress you. So the most frequent market participants are hedge funds and prop trading firms, proprietary trading firms. Also, let me add market makers there, because they're the ones that trade for the New York Stock Exchange. So they do always manipulate the stock price to their advantage, because they're also out there to make profits for themselves and for the firm. So if you're a day trader or a swing trader, these are the players that can wipe you out and trick you into panic if you let them. So my entire course is designed for you to understand finance. That is the reason that I push people to know finance, so that you are better able as a trader to withstand their games of manipulation. And all this will make sense to you once you begin trading. But for now, just yawn and nod. Okay. So these hedge funds and prop trading firms very often take short selling positions, and then reverse their positions maybe throughout the day, several times throughout the day. Then you have life insurance companies, you have pension funds, you have wealthy sovereign funds. Um, so these guys they make rare but large block purchases. They're not frequent, but they're definitely meaningful. And these wealth management firms that handle those accounts usually adjust their positions every 3 months after or right before the earnings results come out, which often, not often, but which at that time create quote unquote tsunamis of volatility. And if you're caught on the wrong side of the trade, you will definitely get wiped out if you don't watch your position size. So the retail investor, which is you and I, consists of roughly 30% of average daily volume in the markets versus institutional investing for the remainder, varying on the different stocks. And if you want to know the institutional ownership of a particular stock, any ticker that you type on Google Finance, you will see there that it says institutional ownership percentage. And again, if you want to know what volume is, just look in the glossary, but it is the number of shares that have traded for a given security. And you can look at daily volume, and there's also, if you see a little 3M next to the volume, that means the 3-month average, which gives you a better snapshot of what the volume has been. If you hear the words smart money on television, then they're talking about the institutional investors. That's another way of them saying that we as retail traders are the dumb money. But even though these firms are wrong many times on the direction of a stock, follow them only because their actions create tides of volatility. If you do end up going against the grain, which means you go against what they say, you better be right, since you will be handsomely rewarded. And Tesla is a prime example. Every analyst kept saying how the earnings were non-GAAP and that the credit rebates were used for the company to prop up their earnings. And then Tesla went from $70 to $260, and everybody finally shut the hell up. And I loved every second of it, and I laughed all the way to the bank. It was awesome. There's another adage that says, Wall Street makes fools out of geniuses every day. Meaning, you might have a PhD in math and consider the stocks as cheap, but if a rich dumb person liquidates 2 million shares of XYZ, no one will care what your smartass thinks. They will sell from panic. This ties in with, let me just first say that this is on a trading basis. I'm talking about day trading. I'm not talking about investing here on the last comment. I want to talk a little bit about the psychology of the human mind. This is how the market has been behaving for the whole century. For example, if you go to a restaurant and let's say there's nobody there, right? You go to a restaurant and you see nobody there. You might not walk in because you will say, oh, probably the food is stale under those heat lamps. But if you see a crowd outside waiting for like an hour to get in, you'll say, wow, it must be good. Let me go see what the buzz is all about. You'll get interested. You might even stand in line for an hour. A lot of people do. So stocks work the same way in a sense. Everyone might jump on Tesla today because of the hype, and then tomorrow there may be crickets chirping. And that's just the human psychology. So what is a stock? A stock is a share in the ownership of a company. Okay? It is also a representation of a claim against the company's assets and earnings. So as one acquires more shares of a stock in a company, obviously the stake also becomes greater. But a great thing about owning a stock is that the ownership to the company doesn't expire as long as you have this certificate. Okay, so stock ownership never expires. But when you trade options, Um, options have time expiration on them, and that's what makes them extremely risky. But with stocks is, as long as it's a great company, you can keep them forever. Excuse me. So public companies have a stock symbol, whereas private companies do not. And companies can become public and then become private again, and vice versa, as we saw with Burger King and Dell. Then, next slide. Let's talk about what does it mean to be a shareholder of a stock. Okay, so when you buy a stock, what does that mean? Being a shareholder means that you don't have to do any of the work that management and employees of that specific company have to do, but you are entitled to the portion of the company's profits as well as have a claim on their assets in proportion on the amount of shares you hold. So let's say if you hold $100,000 worth of Philip Morris, and let's say Philip Morris pays a dividend of 4% a year, then on that $100,000 you would receive $4,000 a year. And you remember, this goes back to the first couple of slides that I was saying why it's a good thing to trade the stock market, because it's like having your own business, but you don't necessarily have to do any of the work. And this is what we're talking about now. You don't like the business, you don't like the management, sell the company and buy another company right away. You don't have to be stuck with that business forever, or go through the headache of liquidating it and closing it down. So for each share you hold, you normally get one vote, okay? Which means if you're a billionaire holding a substantial stake in a specific company, then you have more power of influence in the direction of a company is headed. Carl Icahn, a billionaire investor, I put there control freak, and he is. He takes such a substantial position in a company. I should have put Apple in there. I don't know why I didn't put Apple. But Yahoo, Herbalife. Oh, I don't know. The reason I didn't put Apple in there is because I remember Tim Cook didn't consider his stake in Apple a significant one, but he still got his way. Carl Icahn always gets his way, and he always tries to push a company to pay more dividends, buy back shares, and so forth. Anyway, that's that. One thing I want to mention is on the first bullet point. Back in early 1900s, they would actually give you a piece of certificate that when you bought a stock, they would give you an actual piece of certificate that you would hold on to as proof of ownership. But now, with technological advancement and high frequency trading, these certificates are kept in digital storages by electronic means. So therefore, you don't have to worry about holding on to those pieces of paper physically in your hand, when you buy and sell a stock. It would be insane considering the amount of volume that I trade on a daily basis. All right, moving on. Now, you heard me say the word volatility a few times, and some of you already knew that I was talking about risk. Those two terms are often used interchangeably, okay? So volatility / risk refers to the amount of uncertainty or risk about the size of changes in a stock's value. A higher volatility means that the price of the stock can change dramatically over a short time period in either direction, and a lower volatility means that a stock's value does not fluctuate dramatically, but changes in value at a steady pace over a period of time. Guys, risk is everything in trading. Remember that risk and reward have a diagonal relationship, as I stated earlier, which means if you take a lot of risk, then you should expect to be highly compensated for it. If not, then that is not a good trade to make. Some of the best trades is when you have a limited downside risk but a higher reward potential. If you're buying a small cap company to speculate with, beware of the risks you're taking, because you will lose a substantial amount of your investment if the stock goes the opposite direction. And often you will feel invincible because you will be on this winning streak on making solid gains on small caps, and that will make you bet even more and more on the next round. And ultimately, once you become completely lax with your position size, that's when things will turn around, and it will happen so quick that your mind will be in a denial mode until it's too late. So just beware, that's gonna happen. It's just a matter of time, and that will definitely teach you a lesson. Now I'm gonna give you two examples. First example is, I was watching this show about our troops in Afghanistan, and the captain was reiterating the fact that you have to be on guard at all times. Even though that when they were given the date of them leaving back to the US, our troops, they had to be on guard until the last second, you know. So it's very important. And the second example is completely different from the one I just said about the troops in Afghanistan. The second example is when I was traveling across the country and driving long hours in my car, and each day I would drive and I would stop at a hotel, after driving 10 hours or 9 hours. And I was near Omaha, Nebraska, and I was driving at night, and you're always making sure you don't hit those major truck tires that are left in the middle of the road. And I was already getting ready to pull over and get a hotel. So as soon as I let my guard down and reached to the back of my seat to get a bag of chips, I turned around and I saw a giant tire in the middle of the road, which I barely avoided, going 80 miles an hour. And this was not my first near accident. One time I almost hit a buffalo in Wyoming at the Yellowstone National Park. So this happened again. And anyway, what I'm trying to say is that you should always watch your risk and anticipate the worst that could happen when you have your guards down. Risk is the reason why, after losing thousands of dollars on speculative stocks, I went back trading blue chips to gain more experience. Risk is the reason why so many novices that touch the market wash out in a short period of time or turn into investors at best. So, one not so efficient way of understanding how much risk a company has is its beta. And I will tell you in a little bit why it is not an efficient way in a second. But first, let's define what beta is. So beta is one measure of the relative volatility of a particular stock to the market. A beta approximates the overall volatility of a stock's returns against the returns of a relevant benchmark, such as SPY, which is the S&P 500. And S&P 500 has a beta of 1. Or you can look at it as 100%. So a stock with a beta of 1.1 has historically moved 110% for every 100% move in the S&P 500. Conversely, a stock with a beta of 0.9 has historically moved 90% for every 100% move in the underlying index. So now I would like you to pick two stocks from the Dow Jones and check their betas. But first, let me do that myself. I'm going to check the betas for General Electric and Chevron. And we're going to analyze that together real quick. All right, so there's GE right here. So GE has a beta of 1.36. This means that it is 36% more volatile or more risky in a sense than S&P 500, which has a beta of 1. So again, let's say comparing it to S&P 500 SPY benchmark, SPY, see, it has a beta of 1.00. So if GE is 1.36, that means it is 0.36 more volatile, or 36% more volatile than S&P 500. And if we look at Chevron, you will see that it's 1.12, which is 12% more volatile. But let's find one that's less volatile, meaning less risky. Let's look at IBM. See, IBM is 0.62, which means that it is 38% less risky than S&P 500. So I want to tell you a few flaws that beta has, which I have experienced in the past. One major flaw is that it gives you a quantitative valuation, not a qualitative. Meaning, if I tell you that Coca-Cola has a beta of 0.47, it only tells you that it is 53% less volatile than S&P 500. But it doesn't tell you that consumers worldwide are drinking less soda. It doesn't tell you that Coca-Cola has such a big brand name that it is recognized even in some of the smallest tribes in Africa. It only tells you how the stock price behaved historically versus the SPY, S&P 500. Another flaw with beta calculation is on earnings date. On earnings date release, a stock will rise dramatically or fall dramatically. So completely autonomous of what the beta shows. So I have seen large blue chip companies fall 6 to 8% on earnings day, despite having a beta of, let's say, 0.45. There's a lot I can talk about beta, as it is used in the capital asset pricing model and is fairly highly debated in understanding portfolio theories. But let me just stress that it is a stepping stone into understanding risk of a security that is based on historical data. Okay, now that I've bored you to death, I'm going to cheer you up a bit by talking about the animal farm, stock market farm, of course. So let's get to know the animals real quick. So when you hear somebody say going long, that's the same thing as being a bull, or just buying it outright. So a bull is an investor that wants the stock to go up. And I told you the hint before, a bull hits you with their horns, you fly up in the air, and that's why it's called bulls. And I say that's why there's a bull statue in front of Wall Street, not a bear, because this is the traditional way of investing, because all companies need to grow. So, the goal of each company is not to go to bankruptcy. The goal for each company is to grow and expand as much as possible. And then bears is going short or short selling. Investors that want the stock, well, they're not technically investors, but so these are the, I guess we should say, speculators that want the stock to go down. Bears hit you with their paws and bring you down to eat your face. I have a weird sense of humor, as you have noticed by now. And then we also have sheep, and sheep are the investors who just sit and watch on the sidelines and are scared to make any moves. I have a couple of friends who are sheep. These guys, young guys, 23, 24-year-old guys, but they're talking about investing in CDs and sticking to treasuries and buying bonds, and mutual funds is like the riskiest things for them. But anyway, to each its own. Then we got hogs. Hogs are greedy pigs that don't sell and want their profits to rise higher and higher until it nosedives back to square one. Hogs get slaughtered, and that is the case most of the time. If you get too greedy and you don't sell your stock or you don't hedge it, then you might get slaughtered because other people will start to take profits. Rights of stockholders. This information is not necessary to know, but it's always good to know. So I feel like I'm obligated that I need to tell you this. So I'm just gonna really quickly read through them. And I used to hate it in college when professors would just sit there and just read the entire PowerPoint presentation when I could have done it myself. So now I'm doing the same thing. But I'm just going to read through this real quick. So as rights as stockholders, first of all, you have voting rights, first of all. As I said before, you have common shares. So common shareholders have the right to vote in company affairs. So these voting rights are often transferred for a day through a proxy. So once in a while, when you buy and sell stocks, you're going to get proxy statements mailed to your house. Also, you're going to have class action lawsuits whenever they occur. And let's say you were a shareholder on a specific date, they're going to send you those items too. Like one time I made like $300 from, I forgot which company it was, but they sent me a check. It was great. So number 2 is the right to transfer shares. Generally holders of common stock have the right to sell their shares to another investor without permission from the corporation. So some shares may be restricted in cases where they are received as an employment benefit. So this means that you can actually buy and sell your shares. Number 3, right of access to corporate information. Of course, we all know that you can access everything that a company does is public information, and we'll talk about the 10K and the SEC website that you will pull all that information from. So as a part owner, a shareholder has the right to inspect the books and records of the corporation. In addition, companies are required to report their business conditions to investors on a regular basis. And last but not least, right to declare dividends. When dividends are declared, they must be paid to all owners in proportion to their ownership interest in the company. Again, with the Philip Morris example, the more shares you have, the more dividends you get paid. And you know what? These dividends actually change. If let's say company that is not doing as well as it used to, the board might decide that they're going to suspend dividends or decrease dividends, or then again increase dividends, reinstate dividends. So the company will go through, a healthy company is a company that even throughout recession is able to sustain its dividend pay, if not increase it. And that's one of the reasons why I like Chevron over all the other oil companies. Let's further discuss dividends. So first, let's define what dividends are. A distribution of a portion of a company's earnings decided by the board of directors to a class of its shareholders. The dividend is most often quoted in terms of the dollar amount each share receives, which is dividends per share, and it can also be quoted in terms of a percent of the current market price, referred to as dividend yield. It's easier to look at dividend yield just to know how much will you be getting as a percentage of your investment. And let me also state that again, if a company is a dividend stock, then it is not a growth stock. And some companies, specifically in the technology sector, they're considered growth companies. So a growth company will take their profit and they will plow it back into their company so that they will reach their growth targets. Makes sense, right? And whereas, let's say, a utility company will take its profits and pay as much dividend as it can to its shareholders, because sometimes utility companies, for example, they'll be capped by their local and state regulators. So they can only make so much profit anyway. So it all depends on what the company's best alternative is and what's their overall plan going forward in the future years. So sometimes a company will reach a growth stage where they decide to pay more dividends and cut back on growth, as we saw with Apple. After Steve Jobs passed away, one of the first things Tim Cook did was turn Apple into a dividend stock, which upsetted a lot of people, including me. So let's go ahead and look at different type of dates that a dividend has. So first we have the declaration date, and it is the date where a company will inform the public of their intent to pay a dividend. Then you have the record date, which is the date where a corporation will check to see who the holders of record are. So those shareholders will be entitled to dividends, which will be paid on the payable or payment date. And then the payment date is the actual date on which declared stock dividend is to be paid. So let's go ahead and look at the payment date for Verizon, let's say. Verizon is one of my favorite dividend stocks as well. I have it pulled up here. So, and when you go to, let's look at Yahoo Finance this time. So you're going to go to yahoo.com /finance, and then you will type the symbol VZ. And on the left-hand side, under company heading, click on key statistics. And key statistics has a lot of great key highlights of the company's fundamental snapshot. So on the right hand side, under the column dividends and splits, you will see the dividend date. So this is dividend date, which is the payment date, and it was on February 2nd, 2015, which is incorrect because February 2nd, 2015 hasn't happened yet. And this is a perfect time to mention that Google and Yahoo sometimes do not update their records, or they have false computations, and I've noticed that over and over. So it is better to check on your broker sites, and even on your broker sites, sometimes the numbers are not updated, or there's sometimes glitches that you will encounter. But I think this dividend date means, it means the February 2nd. It hasn't happened yet, but it's going to happen on February 2nd, 2015. And the ex-dividend date is on January 7, 2015. Which, again, hasn't happened yet. That's why I said it's a glitch, even though they already have the dividend date here. And you also have the dividend yield here, which shows a trailing annual dividend yield 4.6%, which is pretty good for any company. All right, going back to the slides. And lastly, let me just state that there's two forms of dividends. There's cash dividends, which I'm used to. I've never gotten a stock dividend yet. So majority of the dividends will be in the form of cash. So a cash dividend is a monetary dividend paid to shareholders, and stock dividend is a dividend paid in additional shares in place of paying cash. All right, moving on. Just to let you know, if I have a heading in a blue color, that means that it's not very important for you to know. It's not necessary for you to know. So it has a moderate level of importance. But again, let me just go ahead and tell you, because I feel obligated, that you need to know what type of voting rights are out there and how it all works. If you are a super wealthy investor and you do have a substantial stake in a company, then this will be it will be very important to you. But if you're a day trader, swing trader, and you have a small position in a company, then you really are not going to care about this. But it's very interesting to know. So cumulative voting rights is a reference to a voting procedure where a shareholder gets one vote for each share held. And this is the common method of voting. So if, let's say, there's 100 shares of Apple is held by a person, and there are 4 open positions on the board of directors, and a shareholder would get 400 votes to apply however he chooses. If he wants, he can actually cast all 400 votes for a single candidate. Okay, so this is the cumulative way. You can combine all your votes, and you can just cast it to one person instead of distributing it amongst the 4. So then there's statutory voting rights, which refers to a slightly different method of voting for directors. The number of votes a shareholder receives is, again, the number of shares held times the number of open director seats. So let's say if you have 100 shares of Chevron and there are 4 open positions on the board of directors, you will receive 400 votes. However, this time you're only capped to 100 votes per candidate. You cannot put 400 votes to one person. So that is the main difference. That is, they cannot cast more votes for a candidate than shares they own. All right? Very simple. Moving on. And now let's talk about the pros and cons of a stockholder. A major advantage is a limited liability. And because you as a shareholder, when you buy a stock, you don't have to worry about personal liability in case the company goes bankrupt. On the other side, if the downside is that in the event of a bankruptcy, the lenders and creditors will get paid first, and then the preferred stockholder, and then the common stockholder. Most of the stocks you will be trading will be common stock, not preferred stock. So common stock will be the last person to get paid, but hopefully it will never come to that circumstance where you're holding a company that's going to bankruptcy, and I will definitely let you know how to avoid that. Once you hear a news that a company has fired a bankruptcy attorney, jump out immediately. Don't even wait for the second day. Unless you're going to short sell the company and write that thing to zero, then be my guest.